Look, here we are, middle of May, coming to the end of the auction selling season, and interesting results as usual in our weekend auction markets. Last weekend we saw markets tracking backwards. We're getting an early sense of that quieter winter market now, I guess entering that phase where we have lower numbers of buyers and sellers, and clearance rates in both Sydney and Melbourne were down last weekend. In fact, Melbourne's now recorded 2-year low clearance rates over the past 3 weekends, and Sydney just above a 61% clearance rate. Usual suspects were the top performers in Sydney. That's the inner suburban higher price regions, lower north, city and east, northern beaches and the inner west continue to produce strong clearance rates. Outer suburbs not so strong. In Melbourne again, the same pattern of results where the northern suburbs and the inner city producing good results for sellers. The outer eastern suburbs not so good. Clearance rates under 50% in the outer east and the outer southeastern suburbs in Melbourne. We look to this weekend for auction numbers. Sign of the times, a real cooling off in activity. We've got around about 550 auctions in Sydney and about 950 in Melbourne. Now that's well below a year ago. For the same weekend we had 1,100 auctions in Melbourne and we had 800 in Sydney. So look, auction numbers are down. Clearance rates are down, sign of the times. I think we're seeing an earlier transition into that winter market. But look, it's a good time if you're a buyer just to take advantage of the last gasp of the autumn selling season. This week we had some interesting data come out, of course, from the ABS. There was a lot of focus on the quarterly wage index data. Of course, the Reserve Bank has been looking very closely at that data. It has been a conundrum for the Reserve Bank, not just Australia's central bank, but central banks around the world have been tackling this issue of low incomes growth despite good labour market activity. So those numbers were important. In terms of looking forward to where interest rates will track, the data was disappointing. We saw annual wages growth for the private sector up by 1.9%. That's the same as it's been for the last 3 quarters. That's the annualised growth in private sector wages. That's just above the all-time record of 1.8% growth recorded in the June quarter last year. So no joy for wage earners in terms of wage increases. And in the public sector, we saw actually the growth rate tick down to 2.3% annually over the March quarter, and that's a record low for the public service in terms of growth in that wage index, and that was down from 2.4% recorded over the December quarter. So these low wage growth numbers, despite strong employment growth, despite lowish unemployment rates, mean that there's really no prospect for an interest rate increase. It means that rates will be most likely on hold for the foreseeable future, and maybe we've even got the prospect of a cut coming through. So we also saw investor data out for March from the ABS. It showed investors tracking backwards again over the month of March. No surprise, we've still got the energy from that APRA action that tightened investor lending last year, impacting the marketplace. Investor levels in all states are down significantly over March compared to March last year. APRA has stated that they're now not going to interfere in the market going forward, which is, I guess, good news for investors, but certainly investor numbers are well down. New South Wales remains certainly the strongest investor market. Investor lending nationally in New South Wales accounts for around about 48% of all lending into New South Wales for national investors, and the local market share in New South Wales is still above 50%, so more than 50% of all residential loans in New South Wales still going to investors. But certainly it's a much quieter market compared to a year ago, courtesy of those APRA actions. We also had vacancy rates out this week for April. Some easing in vacancy rates. Most of the capital city markets remain tight for tenants with low vacancy rates. We did see some easing, particularly in Melbourne, over April. We do have more first home buyers in the marketplace in New South Wales and Victoria. That takes demand out of the rental market, so no surprise there. And of course, April is a holiday month traditionally, so we do see less demand. We saw vacancy rates in Melbourne for units tick up, still low, still well under 2%. Maybe there's also some issues with new supply coming into the marketplace there. We also saw the Canberra market, although vacancy rates still tight, they did ease over April. Again, perhaps a reflection of new supply coming into the marketplace. But overall, rental markets do remain tight. It's a reflection of strong migration, particularly, even though we did see some slight easing because of that holiday impact, and in Melbourne and Sydney because of more activity from first home buyers. So we move into the final phase of the autumn selling season. The winter market's coming quickly. Perhaps it's come a bit quicker than we expected this year.